very educational, and we appreciate the information. It's kind of a different topic than we usually get to hear, and so that was very, very helpful for us, and we appreciate you taking the time to be with us today. Look forward to having you back in the near future. So at this time, we're going to do a interview session for the final speaker. It's kind of a interview session. We're going to ask them some questions and then open it up for any questions you guys might have for them. Our guest speaker today is Eric Senft of IndicatorWarehouse.com. And Eric has spoken at the Trading Pub several times. He's actually doing a special webinar session this afternoon in about 2 hours, and so we'll talk to him about what he's going to cover there. But Eric, real quick, if you can, do a quick audio check, and then we'll go ahead and get started with the interview. All right,
Sorry
just
about
one
that.
second here. Okay, there we can everybody hear Eric okay?
Novia has that tricky little microphone icon at the bottom that I missed. I forgot about that.
That's right. All right, good deal. Well, sound is coming through, and Eric, real quick, if you can, tell us how you got your start in trading.
Well, it's funny. I actually got my introduction into the investment world per se when I was still fairly young. I think back. I usually tell people my first experience was with my cousin Marvin when we were just boys. The Hunt brothers were starting to rally the silver market, and silver prices were going through the roof. So Marvin, being a little bit more ambitious than what I was, he started hoarding quarters for their silver content. So we started squirreling away all these quarters. We would take any dollar bills we had and exchange them for quarters. And we were doing this for about a week until my uncle, Marvin's dad, finally told us that the government had stopped putting silver in quarters a long time ago. So unless we had a quarter that I think it was before 1955 or 1960, it didn't have any silver in it whatsoever. So that was my introduction to the world of investment. Fast forward another 15 years or so, and like a lot of people, I got a flyer from the Ken Roberts company in the mail. And trading and the whole world of commodities was always something I was interested in. You know, this was also about the time that the Trading Places movie came out with Eddie Murphy and Dan Aykroyd. And so trading was very exciting. A lot of people were interested, but there wasn't a lot of information. So I got the Ken Roberts flyer and I applied for the course and subsequently opened up an account, and voila, the rest is history, like they say. That was my introduction to trading.
All right, good deal, good deal. Well, thanks for sharing that. And a quick question for you. What markets do you primarily trade and why? Like what kind of led you to trading those markets instead of just trading normal stocks like most people do when they get started?
Well, I suppose, again, it had more influence with the materials I received from Ken Roberts because he was primarily a commodities-based course. I never really knew too much about the stock market. As our family growing up, they were usually investing in real estate, so we never really had securities investments like stocks or bonds or that sort of thing. Well, I had the savings bond, you know, that you get as a birthday gift for when you're a kid. But I suppose because my introduction was through Ken Roberts, that I've always focused primarily on the commodities markets. And I like the commodities markets because you could buy them or sell them, unlike stocks where people were always looking just to buy low, sell high. That's the stock mentality. In futures, as well as Forex, which is very similar to the futures markets. You can buy or sell with relative ease. You can make money whether the market's going up or down. And of course, futures are heavily leveraged, so it doesn't take a lot of money to play. You know, you can control a lot of gold or soybeans or whatever it is you're trading with a relatively small amount of money. So the markets that I started with were primarily the agricultural commodities. I traded mostly corn and wheat. Every once in a while I take a soybean trade, but corn and wheat were really the markets I was most interested in. Remember, this is still before daily charts were available. You got all your data through the newspaper, or if you were lucky, perhaps you had a television station that actually gave you the close of certain commodities. This was long before there were free charts available on the internet or anything like what we have with us today. Most people don't realize how far we've actually come in the last 10, 15 years as far as internet trading is concerned. A lot of times I would phone the broker at the end of the day and see, you know, where the market's closed, and I would literally plot it on my paper chart, the day's activity, so that I knew in advance of my next charts arriving in the mail what was going on. So I would actually get my charts weekly in the mail. So I was primarily a position trader because day trading that way is virtually impossible. So I stuck to the agricultural commodities, corn and wheat. Every once in a while I take a currency trade, usually the Canadian dollar, sometimes the Aussie dollar, and cattle. I always did pretty well with cattle, and once in a while maybe sugar. Those were the core of the markets that I started with. Especially when I'm day trading, I focus mostly on the index markets, primarily the mini Dow and the NASDAQ, and I focus mostly on those because of the size of the tick value. I used to trade the E-mini S&P quite a bit, but the Dow and the NASDAQ mirror the S&P, but you can take twice as many positions because the Dow and the NASDAQ are only $5 a tick, and the E-mini is $12.50 a tick. So it's going to cost you twice as much to trade the E-mini as it will to trade the mini Dow or the NASDAQ. And that's really, you know, where you get a lot of bang for your buck is by trading a smaller tick amount instrument. A lot of people don't realize that. A lot of people think that the thing to do is to trade something expensive like the E-mini S&P. At $12.50 a tick, they think, you know, that's the way to make money. But no, it's not. Most cases, you're better off taking a smaller tick value instrument. I'll also watch crude. I don't trade crude that often. You've got to give me a pretty sweet setup for crude just because it's such a crazy market. But I do watch crude and I do watch bonds, mostly as an indication as to what's going to happen in the stock indices. Because if bonds are going up, there's a very good chance that the Dow and the NASDAQ are going to go down. And if crude is going down, there's a pretty good chance the stock indices will be going down as well. So you have a direct relationship and you have an indirect relationship. The reason I like to watch the bonds, and I will take a bond trade every once in a while, even though it's 31.25 a tick, so it's probably one of the most expensive markets out there. But the nice thing about the bonds is the bonds are, well, the bond traders are probably the smartest traders in the world. You're not going to fool a bond trader. So if you see the E-mini or the Dow or the NASDAQ go screaming off in one direction and the bonds aren't moving, the chances are pretty good that the move won't be sustained for very long. Because, like I said, the bond traders, they're a pretty tough lot. You're not going to pull the wool over their eyes too often. The oil traders, well, they're a little different. They're sneaky buggers. They're out to snooker you every chance they can get. But oftentimes, crude will lead. So sometimes you'll see crude oil take off in a direction, and there'll be a little bit of a stutter step in the mini Dow or perhaps the NASDAQ, and you'll just have that little bit of a tip off that maybe a move is coming. So that's why I watch those two. I also used to trade, I don't trade it as much anymore, but I used to trade the Stocks 50, which is the European Dow Jones. Very good market. Uh, the Europeans are very methodical traders. You don't see a lot of nonsense when you're looking at a chart from the European stock market. You know, they're very respectful of support and resistance. And that's kind of my trading philosophy is I look for support and resistance areas and trade off of those. The stocks 50 will trade at 10 euros a tick. So right now that's when you're making a profit, it's pretty advantageous because you can be making another 20 or 30% on your money just through the exchange. However, of course, you also suck up a little extra on the losing side if the trade happens to go poorly for you. But those are the markets that I'm most interested in. But I'm not really married to any of them. You know, I'm looking at whatever's moving. When I open up the charts in the morning, I want to focus on the market that's given me a defined trend for the day, or something that looks like it's got some movement to it, and that's probably where I'm going to put my attention.
All right, great. And let me ask you this question. You know, a lot of times when traders start out, they kind of initially struggle. Did you go through that? You know, there's kind of the rare circumstance where you have people that just start out and do very well and continue doing well. But did you have any major losses or struggles when you first started that you had to
Oh
overcome?
boy. Oh yeah. No. I wasn't like Richard Dennis who took $400 and ran it up to what, 10 or 20 million? No, I suffered. I took my share of losses. Yes, definitely. I learned through the school of hard knocks. Um, I busted at least two accounts before I started making some money. Um, and it was all the things that you hear about, but you know, you've probably heard the expression that experience gives you the test first and the lesson later, and you keep getting the same test until you learn the lesson. Well, that was me. And I was a little bit of a slow learner in that respect. I don't know what it is about traders. I think a lot of us are wired to be contrarian by nature. You know, we want to go against whatever the market is doing instead of saying, hey, here's a trend, let's go with the trend. Uh, Habitually, we have to try to go against it. And it took me a while to break that. In fact, there's something that people might be interested in knowing. You know, a lot of times you look at a trend, you can't define the trend. Um, Go with whatever looks the least obvious. In other words, a bearish market usually looks bullish, and a bullish market usually looks bearish. You know, unless there's a well-defined trend, unless you open up your chart and it's quite obvious that you're in an uptrend today, a lot of times your best sell signals will look very bullish when they start and vice versa. So I don't know, the market, I don't really believe the whole conspiracy thing that the market is out to get me, but I do believe that the market does repeat itself certain ways, that buyers and sellers hold off on their orders knowing that, you know, the less experienced traders or the anxious traders are going to get in on the wrong side of the trade, and that will just make it easier for them to realize a profit for the more knowledgeable trader. But yeah, it's I blew through two accounts before I finally learned how to control my risk, not to be so anxious when I'm trading. Uh, the the weak trader is always anxious. The weak trader is always chasing the market. Don't be anxious. There's always going to be another move. I've been doing this for nearly 20 years now, and you're you're always going to get another chance. And it's just human nature. You know, we get anxious. It's that whole fear and greed thing. We're afraid we're going to miss a move. We're afraid we're going to miss out on making some money. But so what? So what if you miss one move? I'm watching a dozen charts every morning. Surely out of a dozen charts, I'll be able to pick up a couple of trades. So uh, it's a hard lesson to learn. It's an expensive lesson to learn, or it was an expensive lesson to learn for me. But yeah, you have to get over being anxious. You have to stop over trading. Over trading is a huge one. You have to learn how to control your risk. Risk control is not risk reward ratios. You know, I was up on the soapbox with everybody else telling people, yes, you need to have at least a 2-to-1 reward to risk or 3-to-1 reward to risk to take the trade until I started trading. And then I realized, hey, wait a minute, this doesn't work. And it doesn't work because I don't know where the market's going to go next. And nobody knows where the market's going to go next. Yes, you can guess, you can give it your best guess, but you shouldn't base a trade on what you don't know. The whole thing about trading is risk control. If you can control your risk, you can make money. So you never want to overcapitalize on a losing position or undercapitalize on a winning position. And that's all about position sizing, and I'll be talking about that a little bit more in this afternoon's presentation. But yeah, it's a very important lesson to learn. And I also started keeping a trading journal. A trading journal is a huge tool. If you don't keep a trading journal now, you should. There is no excuse. It is the easiest thing in the world to do. I just have a 3-ring binder. And every day I write down what trades I've taken. I write down the reason I took the trade. And honestly, it won't take you more than a couple, 3 weeks. You're going to start to see a pattern develop of which trades are working out for you and which ones aren't working out for you. It is the best thing you can do to increase or to shorten your learning curve. Right? Keep a trading journal. I heard a statistic once, I'm sure it was made up, but it just kind of drives the point home that we've all heard that 90% of traders lose money. Well, so that leaves 10% that are making money. So what are those 10% that are making money doing? Well, somebody told me that out of the 10% that are making money, 90% of them are keeping a trading journal. That means that only 1% of traders are good enough to trade without a trading journal. So unless you figure yourself to be that 1%, do yourself a favor and keep a trading journal. It really is the best, cheapest learning tool you can possibly have. I don't know why anybody would not keep a trading journal. You'll recognize when you're over trading. You're going to recognize your better setups because you're going to be making notes of them. You're going to be analyzing your bad trades, trying to find a reason for why the trade did not work out. And maybe the next time the market flashes you that signal, you're going to say, aha, wait a minute. I took that trade just a couple, 3 days ago and it snookered me. I'm not going to take it this time. And it really is. It's an excellent trading tool. So it kind of went a little bit around your question there, Morgan, but
Yes, no
got a
problem.
little
One
sidetracked. Sorry
thing,
about
it was interesting. You started asking, or you brought up the trading journal, and I was actually going to ask you, tell us about your trading journal, but you went ahead and did that. So, yeah, it's a big thing. I think that, and I've had people approach me before and say, hey, I'm struggling in trading. Can you help me? And I've asked them the question, say, okay, well, send me a copy of your trading journal, and then it's kind of silent because you know that they haven't been doing one, and
that.
it's sort of like you think about in pretty much anything, you have to review your performance to see how you can get better if you think kind of about that athletes watching film or like looking at how they performed and ways that they can improve it. So really appreciate you bringing that up. One of the things that I'd like to ask you as well is when you look at trading with whether it's discretionary trading versus kind of think about how some people trade with just complete discretion, watching the market, going with their gut or going with the technical setup versus kind of implementing a system. I know that you've been working a lot kind of behind the scenes over the past years on the diversified trading system. Tell us a little bit about that and what you guys are trying to accomplish with that.
Yes, diversified trading system, or DTS for short, it's a comprehensive trading system. What we found is that most trading systems out there are severely lacking because uh, to have a complete system, you actually need three components. You need to have an entry, you need to have an exit, and you need to have money management. And most of the systems out there only give you the entry. They only look at the entry signal. And most traders mistakenly believe that all they need is a better entry signal. They think if they're losing money, it's because they don't have a good entry signal. But that is not the case. In fact, you can make money with only a 50% system, a 50-50 system, which is like flipping a coin, if you have good money management and good exit strategies. So you really need all three. So this is what we were after with DTS. We were trying to develop a system that was a complete system for people to use, that it's very simple and very tradable and very comprehensive in the sense that what DTS does is it actually analyzes the market from three different perspectives. DTS is comprised of three signal generators. There's the Hawk microscalper, the Falcon swing trader, and the Eagle trend trader. So we're looking for scalp trades, swing trades, and trend trades simultaneously. And each of the signal generators have been tweaked to recognize the specific market characteristics. So if you have a trend emerging, you're going to get a warning signal in the Eagle saying you've got a trend developing in whatever market is you're watching. Same thing if you get a scalp trade. You're going to be alerted that, hey, there's a scalp trade setting up. So it's actually possible that you can have a trend trade, say in the mini Dow. You can be short the mini Dow, it's heading lower, and you can actually get a signal to scalp it to the upside on a short-term reversal. So that's what DTS does, is it looks at the market from three different angles. It looks for scalp trades, swing trades, and trend trades, but it also gives you the complete package because not only does it have the signal generator, but it has the profit manager, which is an automated stop strategy. And it's actually, you get to choose from a dozen different stop strategies. You can tweak them to your own risk tolerances. So you can make it more aggressive or less aggressive. And it's fully automated. With the click of a mouse, you can activate it and it will make your stop live. So that's what I mentioned earlier, that I watch a dozen charts every day. Well, that's how I can watch a dozen charts, is I can actually put on a trade, say in the NQ, turn on my profit manager, and go watch crude oil, knowing that the profit manager is going to handle my open position, and that will allow me to look elsewhere for another opportunity. And then the last component that I touched on was money management. And with DTS, we also have what we call the risk manager. Now, in my opinion, the risk manager is probably the single most important tool because it does position sizing for you automatically. So with risk manager, you are never going to overcapitalize on a bad decision, and you're never going to undercapitalize on a good decision. So you're never going to end up losing more than you can afford to lose on a bad trade, and you're always going to maximize as much as you can make on a good trade. Like that, we've all heard, cut your losses short, let your profits run. But nobody ever tells you how to do that, right? It's fantastic advice. How do I do it? This is how you do it. You have to limit your risk exposure to only a certain percentage of your account, ideally 2%. And so that means your risk stays constant in any trade. And you adjust your position size so that your risk amount stays the same. So just a real quick example. Let's say you're looking at a position in the E-mini S&P. You want to go long. And from your entry to your exit, you're looking at $500 risk. All right. So let's say you're trading a $25,000 account and you want to risk 2% of your account. That's $500. So that means you can only take one lot. You can only take one position on that trade. But let's say you get another setup in the E-mini S&P, and now it's going to cost $100 from your entry to your intended exit. Well, now, because your risk amount is $500, you can actually take 5 contracts on that trade. If it doesn't work out, that's okay. You've still lost, yes, you've lost $500, but you haven't lost more than you can afford to lose. You see, what most people do wrong is they invest far more than what they can afford to lose. For instance, when I started trading, and like I said, this is going back a ways, I started with a $10,000 account. My very first trade was a $1,500 risk position. Well, that's insane. I'm risking 10% of my account. Most people will do that without thinking twice, but what most people don't know is that, and this is what money managers and professional traders all know, is that there is a very real possibility that you will take at least 10 losing trades in a row. Sometimes you may even take 20 losing trades in a row, believe it or not, but there's a very distinct possibility that you will take 10 losing trades in a row. So if you're routinely risking, say, 8, 9, 10% of your account, and you take 10 losing trades, well, you don't need to be a great mathematician to know that you just had an 80 to 100% drawdown on your account. In other words, you've busted your account. But if you're only risking, say, 2% of your account, which is the ideal number, and I realize it has to be a little bit of a floating number depending on whether you have a larger account or a smaller account, but anything less than 5% is considered prudent. And you hit that bad streak where you have 10 losers. Well, 10 times your 2%, you've had a 20% drawdown. Yes, it's still going to hurt, but it hasn't wiped you out. And that's the whole point. That's what people don't understand, is they end up risking far more than they can afford to lose, and then they wonder why they blow up their account. So if you want to know the real secret to trading, control your risk. So that's what DTS does for you. It gives you signal generators. It gives you profit management or exit strategy, and it gives you risk management. It's the closest thing to a fully complete trading system that I've ever seen, and I've seen quite a few. And we've designed it to be as simple as possible. There is very little thought or discretion involved in taking the signals. It's not a black box system. It's not programmed to take every single signal, but we have tried to keep it as simple as possible so that when you go to use it, you get a buy signal, you buy, you get a sell signal, you sell. You get correct position sizing, you get correct trade, and at the end of the day, hopefully you're making money. So that's the long-winded Reader's Digest version about DTS, but it's very exciting. I'm quite proud to be involved with it.
All right, well, very cool. And real quick, we've got about a minute left, and you're joining us this afternoon in the same room so you guys can actually just stick around, and we'll leave the room open if you guys want to stick around and hear Eric. We'll get started in about an hour and 45 minutes. But talk to us a little bit. The subject is cracking the code, building a complete day trading system. Talk to us a little bit about what education you're going to share this afternoon, in case somebody wants to stick around.
Well, it's going to be a little bit more of some of the things that I just went over, namely what you need to look for when you're developing a system. The three components of the system: the entry, the exit strategy, the money management, why it's important, and the kind of things that we look for at Indicator Warehouse when we're putting a system together or when we're evaluating a system, because a lot of systems come our way. We get a chance to take a look at a lot of these things. But yeah, that's what we're going to be looking at. If you're either evaluating a system or you're looking to design your own system, what kind of things should you be looking at? That's what we're going to be discussing.
All right, very cool. Well, thanks again, Eric, and we'll see you back here in about an hour and 45 minutes. I'd like to thank everybody for being here with us today. We will go ahead and leave the room open. Like I said, our next event is at 3:30 today, Central Time, so we'll just leave the room open. We'll go silent in here around for that event.